Okay, hello everyone. Okay, our data office side friends have a presentation on Wednesday at 4. This is someone from the Writing Center here on campus, talking about professional writing, business writing. I think there's probably a lot for any one of us to learn from this. So these are always good events to attend, a small investment of time, for I'm sure you will learn something. If you haven't had professional business communication yet here on campus, this is really important. And I think what I was reading between the lines here, what you talked about, is understanding how to communicate precisely and efficiently in a business context, right? This can be to your supervisor, partner that you're working with, your leader in your organization that you're working with, or your client. Many people read things on their phone now. So I always got frustrated with people that would write me something very long, because I'm sitting scrolling, and I'm like, I can't get through it. I mean, I don't have 10 minutes to sit there and read that on my phone. So how can I quickly get to the point without leaving pertinent facts out of the analysis, right? That's a skill to master, just to be able to do that. And you'll also find that you need to tailor this to your audience. Right? Some people like get to the point, answer the question. Right? And other people want to understand the rationale a little bit more. So I think this will be a very good session to kind of understand a little bit more about that here. Okay. So lifelong communicate well, both orally and written. Okay. I want to, the goals for today is to finish chapter 2, okay, with appreciation. And appreciation, very process oriented, right? We got steps we have to follow. We covered personal property earlier, so this is not personal use property, this is personal property, which is just the broad category of it's not real property, okay? Real property we're going to pick up today. You'll see the process is similar in some respects, a little bit different. We got to get to the right table, and we got to be in the right place on the right table, because that's going to give us our percentage of depreciation we take in that particular year. After we get done with that'll finish up our basic rules for depreciation after we finish real property. Then we're going to go into the special rule, which is what makes depreciation such a challenging aspect, is because that's where the government is interjecting themselves into business decisions, trying to influence those decisions. And they did so in their latest example of that in the One Big Beautiful Bill Act from last year. So for real property, we need to subcategorize it into one of 3 areas. Land, that is never depreciable. Okay? I view that because land is so special. It never depreciates in value. Never the wrong word. It rarely depreciates in value, right? More times than not, over a long enough period of time, real property that is represented in land goes up in value. It's a finite resource, and it usually increases. Then we have our second category, which is residential real property. This is where people live. Houses, condominiums, apartment complexes. That's residential real property. You can imagine what is non-residential real property. People don't live there. Offices. You're not going to live in your office. You shouldn't live in your office. Manufacturing plants, shopping malls, those types of locations are non-residential real property. Okay? So that's the buildings, the things that are permanently affixed to the land, but not the land itself, not the dirt itself.
What about in the cases where like it's an apartment complex, like the bottom might be like a Starbucks, but on top might be more apartments?
So
it's owned by like the same thing.
Would
it be considered one property?
So great question. I think that would have to be bifurcated. So take the total value of it and have to break it up
kind of
in
weigh
the first floor. But you're right, yeah. There's rarely, especially in a city, there's not pure apartments. There's so many storefronts. Great question. If a building is substantially improved via expansion at some point after it was placed in service, the addition itself is treated as a new asset with the same recovery period as that of the original building. So, not uncommon to have a big factory and then the company expands over a period of time and wants to build a new line. So instead of building a brand new building, they just build onto the back of the existing building. So that is itself a new non-residential real property that you would then put into your depreciation records and start a new asset. Even though everybody would think it's just a expansion, right? Move the wall out further. Technically, that's a new asset. Okay. I have three things I got to do here. I got to do the depreciation method, the recovery period, and the depreciation convention. The first and the third are very simple because they're the same. Okay. Land, I'm not doing anything, right? Land just sits on the. I never depreciate land for tax purposes. I'm not depreciating it for financial statement purposes either, right? So it's very simple. If I get land out of the way, then I only have 2 and 3, residential or non-residential. So the depreciation method is straight line. Okay, so no accelerated depreciation here. There's one caveat because the One Big Beautiful Bill Act added a new category that we hadn't had before. I'll explain that. But for residential real property and non-residential real property, it is straight line. So no acceleration that we're going to do. So you'll see the percentages are not skewed in those tables to earlier years. The recovery period is prescriptive. They tell us that. So non-residential real property is 27 and a half years. Don't ask me why they do the half. They do a half. And then for, residential real property is 27 and a half. Non-residential real property, I have 2 potential recovery periods. It's 39 years if placed in service after May 13th, 93. I don't even remember what happened May 13th of 93. But I'll venture to tell you it was a change in the law. So that's why that law was introduced on that day. And so that's the line in the sand as to why it's not even the end of a month. And it's 31 and a half years if placed in service after December 31, 1986, but before May 13th of 93. The reason we got to know these 2 dates, even though they're very, very old, especially for this audience, is that I could have property that is still within the 31 and a half years that was placed in service before 93, right? So whenever I place something in service, whatever the law was at that time, it just carries on. So I need to keep doing what I was doing back then. But for all intents and purposes, new non-residential real property is 39 years. That's an enormous amount of time, right? Almost 4 decades where I can recover this large outlay through taxable income. Okay? You'll see in what I mentioned about the new category how we greatly change that for certain types of non-residential real property. And then my depreciation convention, they just tell us it's mid-month. And we don't have to do any kind of testing. Remember, we had to do the testing on the personal property to see if more than 40% of total personal property was in the 4th quarter. I don't do that here. The tables I go to automatically throw me in. You're mine.
Just to clarify, for if a property was 31 and a half years and you add on to it the significant improvement you're talking about on the last slide, would it also be 31 and a half years or is it 39?
No, it would be 39 if that addition was after May 13th of 90. Treat it like it's a new asset. Everybody else will think you're totally weird in the business because they'll say, well, that's just the same factory, just bigger. Well, technically not under the eyes of the tax. Okay, so this slide is very similar to the slide I went through on Wednesday. If you follow these steps, you will get every question right on depreciation for real property. Okay, I use the mid-month convention. It's required and it's factored in the table, so I don't have to do that 40% tax. Locate the applicable depreciation table. That's from the revenue procedure. The only thing I got to be cognizant of here is the type of real estate. So if I'm doing I'm looking at the table for residential real property, but it's not residential real property, I have the wrong table. They're different years, different recovery periods, right? So I just gotta make sure I hone in on all these crazy facts. What is the property? Is it a warehouse? People don't live in a warehouse. Is it an apartment building? Okay, then I'm gonna find that table for that particular type of property. And then I select the column that corresponds with the month placed in service for the real property. So you see the columns, there will be 12 columns, 12 months. Whenever that property was placed in service, that's where I start on that column. And I stay in that column for the entire time I own that property. You'll see it's mid-month, is all this small amount in the first year, and a small amount in the last year, and then straight line down all those other years. Then I find the row on the year that I'm asking about. Typically, the questions are going to be about the first year, but if I'm in year 5, I'm going to be in the 5th row for that column of the month that was placed in service. The depreciation tables take into account all these factors. So if I get in the right table, the right column, the right row, bang, I got the answer. So let's do some examples. 2-9, Marissa?
Yeah, so looking at this example, as indicated in one of the other examples, Teton's cost basis in the warehouse it purchased on May 1st, 2024 is $275,000. What is Teton's 2024 and 2025 depreciation on its warehouse? And so we're using the table that's below to calculate. So in 2024, we see that we're using the straight line method, 39-year recovery period, placed into service in May. So with the $275,000 tax basis, and the rate is 1.065, because we're looking at year 5 going across and year 1 going down. And so that's 1.065.
But month 5.
Sorry, month 5.
Month 5.
Month 5, we put in place in May, and we're looking in year 1. And so that's 1.605%, and so we multiply that by basis to get the 4,414. And then in 2025, we're looking at the same thing, except for now we're 1 year later, so we're looking at years 2 to 39 rather than in year 1, but we're still placed in service each month.
Yes.
So that's 2.564%, multiplied down, and again, we get 7,000.
So you see in the table, it's years 2 to 39. That's the straight line element of the computation, because the 2.564 doesn't change in the foreseeable future. And it's a 39-year property, and I go to year 40, you get mid-month. I'm getting a small amount in the first month and a small amount in the last month. Everything else in the middle is straight line for a large number of years. Right? So this is table 5. Remember the other tables we talked about last Wednesday. Table 1 was half-year convention. That's when I fall out of the mid-month, right? When I don't have 40% put in the 4th quarter, then I'm in half-year. That's table 1. Tables 2, 3, 4 are the mid-quarter when I have a mid-quarter convention. When I do have 40%, so I have 1st quarter, 2nd quarter, 3rd quarter, 4th quarter. That is those tables, and now I'm at table 5. Sorry. But when you go through, I will give you all of these tables. They'll be stapled on the back of the exam. If I happen to ask you an exam, a appreciation question, you just need to know how to work through these examples. If you understand how to work through these examples, you're going to get it right. Okay. But if you're not on table 5 in this example, you got it wrong. Okay. 2-9, the next point is Jessica. Okay.
So what would Teton's 2023 and 2024 depreciation be if instead of a warehouse, the building was an apartment building that are rented to Teton's employees? So the answer would be $6,251 in 2023 and $9,995 in 2024. So the table shows that we're using the straight line method for both apartments, and the recovery period will be 27.5 years because this is an apartment is a residential building. And the date of service would be the same. It would be May 1st of 2023. and the basis would be $275,000 for both of them, and the rates would be 2.273% for 2023 and 3.636% for 2024. And if you multiply those, you get the respective numbers.
You got it, so you gotta be on the right. So now I got my tables lined up right. So table 1 was the half-year convention if I fall out of the mid-month test that I do. And table 2 is all of the mid-months. So there's 2A, 2B, 2C, 2D for each quarter in that year. Table 3 is this table for residential. And table 4 they should be sequential. I'll look at that. But I will give you all these tables at the back of the exam, so you guys will be able to find that. But, and the point being on two different cases in 2.9, example 2.9, it's got to be in the non-residential or the residential. In that prior example we had here, prior question, I would bifurcate the property between the storefront and the residential floor. Okay. Okay. So keeping in mind those recovery periods. 27.5 or 39 for recent, relatively recent non-residential real property. Enormous amounts of time to recover your investment. And remember, I want to recover this through taxable income, and I'd like to have my taxable income as low as possible. There's no acceleration here. So there is a concept called a cost segregation study for real property. And the way to think about a cost seg, people call this cost seg studies. A cost seg study involves the process of identifying personal property assets that are included in the purchase price of real property. Okay, so personal property includes the non-structural elements of a building. Think of the electrical system, the plumbing fixtures. They are parts of the building, but they are not the structural components of the building. Right? They're not the girders that hold up the building or the bricks on the outside, those types of things. They're the things on the inside that actually make the building, usable by humans. Right? And exterior land improvements could be there, so landscaping, surface parking lot, those types of things, and indirect construction costs. So a cost seg study takes in, something might cost you $10 million for a new office building, but let's get inside that $10 million and see if we can carve out pieces of it. And what we're looking for is categories of property that we can recover quicker than multiple decades, right? The stuff we talked about last week, some of it's 5 years, some of it's 7 years, much quicker. And so can I get very intrusive and break it down and say, okay, here's what the total package is, and try to minimize that part that is in longer life recovery periods for real property. And so I get quicker recovery periods, and then we're going to talk in a moment about 179 expenses and bonus depreciation that greatly accelerate that from the maker's rules for that non-real property of real estate. And I can't do that with real property. I can't do, besides the special category I'm talking about from the One Big and Beautiful Bill Act, I cannot do, I know you don't know it yet, but 179 immediate expensing or bonus depreciation on those assets. So if I can go in and carve out some of the larger purchase price into those component pieces, maybe I can carve some of that out and count that as the quicker recovery. So here's a nice example of the power of these studies. And these studies are done by all the big four accounting firms. It's very lucrative. They're very adept at it. They know what the IRS wants to see, and they kind of pay for themselves because you're going to get a multiple of return on these versus the time you pay to get these reports created. So consider a taxpayer who purchased a strip mall for $1 million, excluding land. So we're talking about all depreciable assets now. It just depends on is it real estate, real property, or personal property. And it would have been a 39-year asset because it's non-residential strip mall. So it's the longest lived asset that we have. So it's an enormous period of time before I get all this back taxable income. So they would have claimed, if we'd have done that work after 5 years doing that tables that we just went through, that would have been 114,330 of depreciation deductions on $1 million outlay, right? So cost segregation study, if on the strip mall identifies 5-year property of 200,000 and 15-year property of 250,000 and the remaining 39-year property is 550. So I took 450 of the $1 million purchase price and moved it off of 39-year recovery to 15 and 5 years. That was the end result of the work here. And doing so would have claimed 345,000 of depreciation expense versus 114,000. Right? It's an immediate payback and an annual payback that's going to keep coming, right? Because I've accelerated that recovery period. And if I would have done what we're going to talk about in bonus depreciation into consideration, I might have bumped up that 345 to 412,000 of depreciation. So I'm accelerating that activity. Now, you probably get engineers involved in this, so it can be a pretty expensive study because you really got to have your facts. So understanding what are the component parts of the business, but these are one of those things that I think most well-advised taxpayers have this in mind while they're designing the facility, right? The best time to capture this information is when it's being done, right? You get all the bids, you got, okay, here's the plumber, here's the electrician, here's all these things. I want to capture all this stuff with an eye that I'm going to do a cost segregation study at the end and prove to the government that a lot of this is quicker assets than the real property itself. Okay. So here's the One Big Beautiful Bill Act that changed. So look at what we're doing here is we would have been in this bucket here. Sorry, it's getting really messy. But I would have been non-residential real property, new property that I put online, 39 years, right? What changed in the One Big Beautiful Bill Act? They created a category called qualified production property. Whenever the word qualified is in there, you know there's conditions. You have to be qualified to be able to avail of these rules. So the One Big Beautiful Bill Act of 25 introduced a new class of property. QPP is what people are calling it. Okay. The definition of QPP is non-residential real property used for qualified production activities, which is manufacturing, production, or refining of tangible property in the U.S. Who's writing these rules? The Republicans have control of the presidency and Congress. What is one of the initiatives of the Republicans in control is to increase activity in the United States, manufacturing activity in the United States. So and the regulations are being written as we speak about this, but they have some of the guidance out. So the construction window is after January 19th of 25. Why January 19th? That's when they first started talking about this. So if you were doing this before, we weren't influencing your decision because you were already doing this activity. So they're looking for people who started doing this activity after we started talking about it, which is January 19th, but before January 1st of 29, right? Doing this type of build is time extensive, right? It takes a period of years before something's up and running. You need to do that quickly. So you need to start the construction after January 19th, but before January 1st of 29, and you have to be placed in service after July 4th, which is the date that they signed the One Big Beautiful Bill Act, the president did, but before January 31 of 2031. So what the Republicans are going for, and I'd say Republicans because they're the ones who voted for this, Democrats did not vote for the One Big Beautiful Bill Act, is they want you to do something soon. Why? We want activity. Break ground. Start building. Hire people. Why? We got midterms coming up. We got a future presidential election. We want things to be happening that we can point to at that point in time that I did this by virtue of voting for this, that this type of activity is creating economic activity. Look at this tax benefit. You get 100% deduction currently of the cost of the qualified production activity. So if I said you could get something over 39 years, something in the first year, I think we could, kindergartners would say, I want that in the first year. Really powerful, right? Take all of that investment and take a deduction current. Again, trying to really dangle a carrot in front of the decision makers. So if you're thinking about, I need to build a new production facility for whatever product I'm doing, maybe I can do that in China, maybe I can do that in Mexico, or I can do that in St. Louis. If I start running models, I get 100% deduction for that outlay. What if that costs me, $50 million to build? $50 million deduction on my tax return? CEO is going to say, well, we're building in St. Louis, right? And so you got to meet those parameters, but if you qualify, you can do that. But, so this is an example of, a very recent example of the government using the tax code to influence behavior from a business perspective. Dangle a carrot or put a stick out there. This one happens to be a big carrot. Okay. So, 215. Ethan?
My question is 220. 211. Sorry.
Which one? Sorry.
211.
211. Oh, 215. Logan. Sorry. Sorry, guys. My fault. I keep you on your toes when I ask you. Oh, you're not ready. Sorry about that. Go ahead.
So the question is, assume that Houston has construction of a new facility to produce equipment on March 23rd, 2025, and placed in service of October 15th, 2025. Total construction costs amount to $2 million. The new factory building contains an office space for Estaban and human resources that is 20% of the facility. In addition, the facility includes a lunchroom for employees that represent 5% of the facility itself. A portion of the facility cost will be QPP, and the answer is $1.5 million because you have to deduct the $500,000 that won't be used for.
Yeah, so it's qualified production activity. They're looking for just that area of the facility that's used to make something. Right? The focus here is on manufacturing jobs. That's what I'm trying to bring back to the United States or create the United States. And so the power here is the bottom part. 100% deduction for $1.5 million. Right? Lowering your tax liability in year one instead of 39 years. I think it's, I was trying to think the other day of an example where it's such a drastic change, but I can't come up with one. One that was nearly 4 decades to recover costs in 1 year. Kind of amazing. So it'll be interesting to see, once we get a little bit further into this, is how much activities is actually generated in the United States. But you think of all the different things that could come from this, because you build a facility, then you got to put things in the facility, right? You got to buy carpet, you got to buy all this other stuff. There's a lot. It's just like it could be a big construction boom. I think is the goal here. Okay. Okay. So that is the basic rules. Now we're going to shift gears into the special rules. The reason this is challenging is because these regimes run side by side. Okay? We don't replace things, we just add things on, and some things will supersede others. But the challenge you have is things come online at different times in the past, and the rules that govern them are the rules as of that point in time. Like the question we had earlier about what if something changes? Well, what's the law when you place it in service? Okay. So, in addition to the basic rules, we also oftentimes have special rules. Think of them as economic stimulus. That qualified production property is an example of that. I just put it there because it's real property, but it is a special rule. It is not long-term, so it's temporary in nature. When I say temporary in nature, that means that law that was passed on July 4th last year, One Big Beautiful Bill Act, sunsets on qualified production property after a period of time. Congress doesn't have to do anything, the president doesn't have to do anything. If they don't do anything, it stops at a certain point in time. That is a temporary law. Okay. Other laws we'll talk about in this area, in One Big Beautiful Bill Act made them permanent. And when I say permanent, I mean write it in pencil or put quotes around it because nothing is permanent, right? The government can always change the law. It's just permanent that the words of that law do not have an automatic sunset within the four corners of that document. Meaning that the law has to change affirmatively to make that not be the rule. Okay. That's pretty powerful from, I think, from a business standpoint because the C-suite will accept that they understand nothing's permanent, right? There is no certainty in the world whatsoever. They know that from a business perspective. The law can always change, but they tend to hate these laws that are written with automatic changes in the law. It's like, it's just, I know it makes things incredibly complicated. It makes it very lucrative for a tax advisor, but it antagonizes the C-suite because it's like, you guys just make things the law, but they're dealing with budget impacts. That's why they do this type of thing. George.
I'm wondering if this applies to renewed properties. Does it apply to renewed properties?
Into what?
Renewed. If you buy, for example, a shop that was renewed within this given window, it had been bought 5 years ago, before the given window.
So you're talking about the qualified production property. I think that when you get into those rules, and I'm still learning it as everybody is learning it, it applies to new property. So I think there are some specific, there might be some elements where you could buy something and it's new to you, but it hasn't been, it's not a brand new self-created asset. But I think largely they want that new facility to be built, right? Because they're trying to create jobs. And there's more jobs when it's a flat piece of land and somebody has to go in there and build a factory. Then buy an old factory and get it renewed and ready for your use. So I think the rules are aimed more at brand new property. Okay. So the interaction and ordering of the special rules and the bonus depreciation rules, oftentimes being temporary, cause this to be a challenging area. Because the government's trying to incentivize activities, so they make it accelerated. These are the special rules are all about accelerating deductions for depreciation, but they change over time. So that where you are at a particular time is very challenging. So I think the best way the ideal order for analyzing this, and the way we talk about it, is we talk about immediate expensing, then bonus depreciation, and maker's depreciation. Now, we talked about maker's depreciation already because that's from 1986 forward, that's been the regime. We have these temporary regimes that can come online at different points. But I think this sequence is not a chronological order. I think this is the best way to approach how do I want to depreciate a new item. First, can I get immediate expensing? That's section 179. We'll talk more about that in a moment. Then, if not, do I do bonus depreciation on that asset? That's 100% immediate deduction. We'll do that in a moment. If not, then I fall back to maker's depreciation. Okay? But I could have a whole roster of assets that have been put online for the last 10 years that are in various sequences of this law when placed in service. Okay? That's why it can be such a challenge. Okay, let's start first about immediate expenses. So this has been a relatively long-standing provision that the government tweaks within it, but it's not a brand new provision. Okay? So it's section 179, that's the section in the tax code, and as long as I've been practicing, it's been a section 179. It is to allow immediate expensing for qualified property. I think it's more focused towards smaller businesses because the limitations you'll see on it take all the big companies out of it. So Ford Motor Company, who I talked about last week, and showed you their property, plant, and equipment, is not doing 179 immediate expenses because they're capped out. Okay, so it is commonly referred to as immediate expensing, or you hear some practitioners call it Section 179. It's the same. Okay, so it's one of those areas where you don't get too confused about how people are referring to it. Qualified property consists of tangible personal property. So two things there. Words have meaning, right? Tangible, not intangible. So things I can touch. It's not formulas, recipes, those types of things, patents, copyrights. It's tangible things, things I can touch. And it's personal property, not real property that we just talked about. Right? So again, things that are not real estate. Okay. Used in a business and certain improvements to existing non-residential real property, noting that the real property itself is not eligible for immediate expense. So I could have improvements. So a lot of times if I have non-residential real property, I have to do improvements to it over time if I'm the owner of it. Keep it current and get the most amount of return on that asset. If I have an improvement on that, that can count under the law for 179 expensing. But the real estate itself, that original investment, I'm under those prior tables that we talked about. Okay. Instead of depreciating assets over its recovery period, which would have been the requirement on the maker's rule, which would have been the mid-quarter or the half-year convention tables that we talked about last week, then under 179, businesses may elect to immediately expense up to $2.5 million of qualified property placed in service in 25. That number just got changed in the One Big Beautiful Bill Act. It went up. Again, same methodology, same rationale as what we talked about on qualified production property. If I try to increase your deduction for tangible personal property, think equipment, machinery, that's going to make you buy it. If that makes you buy it, that makes somebody have to make it. That's a job. For economic activity. So this is, again, the government getting in here and turning the screws on these rules, knowing businesses read these things and will make decisions in reaction to these and increase economic activity. The 2.5 million is pulled out of those tables, not over time, but dropped in as a deduction in year one, just like that qualified production property. Okay. When a business elects immediate expensing for an asset, it reduces the basis of the asset before it computes any maker's depreciation allowed for any remaining depreciable basis. So I can only do 2.5 million. If my asset is more than the 2.5, then I have excess basis that then goes through the maker's table or bonus depreciation. Right? That's that horizontal methodology where you do immediate expensing, bonus depreciation. So I can do excess of that, but the portion I can immediately deduct is limited to 2.5 million in 2020. A taxable income limitation precludes immediate expensing from creating or increasing a business's net operating loss. So if I'm already losing money operationally, if I have more expenses than I do income, if I'm running a loss, I cannot do immediate expensing to make the loss bigger. Can't be in the rules. Okay, let's do 211. 211 is, gotcha. All right.
But this key idea in this question is always when the section 179 is elected, we take the section we take the section 179 first, and then we apply the makers to remain the basis. The machinery has a total cost of the $2,860,000. The problem states the T10 is eligible for elected to claim the maximum, the section 179 expense. So in the 2025, the maximum section 179 deduction, the $2,500,000 after taking the section 179, we reduce the basis of the machinery. That leaves us with the remaining basis of the $360,000. Next, we apply the maker's depreciation to remain the basis. The machinery is a 7 years property, and the problems tell us to use a half-year convention. Under the makers, the first year depreciation rate is a 7-year machinery is a 14.29%. So the makers depreciation is 360,000 times 40.29% equal to the $51,444. Total current year depreciation is a section 179 expense plus the maker's depreciation is $2,500,000 plus the $51,444 is equal to the $2,500,000 $551,444.
Yep, perfect. So, first I take the first slice out as immediate expensing, put that on the tax return, and I have basis left over. I just treat that as I bought a piece of machinery for $360,000. I look for the recovery period. If I go back to that one slide that gave me the 5 steps, just run through those 5 steps. What's the recovery period? I think I tested for mid-quarter, not the case here. So I'm falling to table 1, and that's going to be 7 years, and you get used to what these percentages are. But 14.29 is the first year, 7-year property under makers, table 1. And then I add the 2 together, that's what's going to be on my depreciation expense line on the tax return. Okay, there is a phase-out limitation. This is why the big companies do not get this. This is why I think it's focused on small businesses. So the maximum amount of immediate expensing a business may claim per year is subject to the phase-out based on the amount of qualified property placed in service in that year. Specifically, the 2.5 million maximum is reduced dollar for dollar for any amount of qualified property placed in service over a $4 million threshold. So we don't have a small business, big business kind of dividing line. Remember, we had that 31 million of annual gross receipts average over the prior 3 years. We don't do that. We just look at the amount of CapEx that you're doing that's qualified as property. That's why it's indicative you're a big company. All right? If you're a Ford Motor Company, remember those numbers I was showing you? You blow through $4 million probably in the first week of January. You're through that, and you're out of this. That's why nobody there probably knows what 179 is. So if you do the math, the phase out is gradual. So if a business placed 6.5 million or more of qualified property in service during 2025, it will not be allowed any of that 2.5 million immediate expenses. Okay, so this is really for your smaller businesses. Still very, very powerful for those businesses, right? But it's not going to be your big asset. Out here, phase out. And any phased out portion of the maximum deduction at 2.5 disappears. There's no carryover to future years, just you don't qualify. So you can imagine when the large companies see immediate expensing, they're like, well, that sounds great, but that doesn't help me at all because I go through that in the first week of January. So that doesn't qualify. I don't qualify for that. And we'll talk a little bit about what they get. Let's do the phase out example here. So Shin Ying.
So for the small businesses, so there's like obviously the maximum for what like determines whether it's a small or big one, but like is there any like threshold that company has to meet to even meet the small business requirement? Like what if they're spending like a couple thousand for like qualified?
No. It all counts then.
Okay.
Yeah. So if you're below the 2.5, you're just taking that bang, that's a deduction year 1 every year.
Okay.
Yeah. So you can be really small and just taking the full deduction. Okay, go ahead.
$1.64 million. The additional 400,000 storage building does not affect this amount.
Yeah, so let me pause you for a second. So, what this is showing is I'm right at I'm just over the threshold, right? So I'm getting phased out, but I'm not fully phased out yet. So maybe I'm a medium-sized company. So, the threshold at which I start becoming phased out is 4 million. I did 4.86. I'm not fully phased out because I'm not at this 6.5 million. When you do the math. So, therefore, I still have some ability to take immediate expensing, but not the full 2.5. Right? Okay, go ahead.
The storage building does not affect this amount because real property is not qualified. So the maximum expense remains $1.64 million.
Yeah, so that's a nefarious what if that somebody could pose to you, try to trick you. But keep in mind, real property is not eligible for immediate expense. We have that qualified production property we talked about, but this is a storage building. May or may not be that new regime, but under the immediate expensing rules, it's only tangible personal property. Okay, choosing assets to immediately expense. You can choose which assets you immediately expense under 179. So most businesses, profitable businesses, tax-paying businesses, are seeking to maximize their depreciation deductions. They want to have lower taxable income, pay less tax. They should immediately expense the assets with the otherwise lowest first-year cost recovery percentage, including bonus depreciation discussed in the next section. So if you're going to if you go asset by asset to build up your 2.5 million or your maximum deduction, you want to take the ones that have the least amount of otherwise current deduction in the current year, right? Because this puts them as an immediate deduction. And so I would just go through and do all my work and then go through and cherry pick assets to choose to apply 179. Okay. That's 179. Very segmented for those relatively smaller CapEx businesses. Still material, but not the big mega companies, right? So think of them, they're sitting there thinking, okay, I got this maker's depreciation, but it's either 5 years, 7 years, it's more extended than smaller companies who are doing this at an immediate expensing over 1 year. If you really wanted, I'm just telling you the story they're telling the government, if you really want to move the needle on economic stimulus, get us something that we can do this on because we do this at scale, right? Hence bonus depreciation is what it's called for. And so this really opens up the number of taxpayers that are eligible. Okay? Again, a stimulative underlying rationale for this. So Congress occasionally enacts temporary depreciation rules. So since 2001, so the last 2.5 decades, businesses have had the ability to immediately deduct a percentage of the acquisition cost of qualifying assets, which everyone refers to as bonus depreciation. The qualifying assets are usually those with a regular depreciation recovery period of 20 years or less. So we're still talking about tangible personal property, right? Because what we started with this morning, our real estate is 27.5 if it's residential and non-residential 39, right? Those are not 20 years or less. Okay? The Tax Cuts and Jobs Act increased the percentage allowable from 50% to 100%. So Trump 1.0, when they came in, Republican president, Republican Congress, they decided to do their big seminal tax legislation, Tax Cuts and Jobs Act. They increased what was a bonus depreciation level of 50% to 100 through 22. This was a temporary provision. What happened in 22, see how this chart goes from 100%, starts falling, 80, 60, 40. It was projected to go to 20%. That's the temporary nature of that legislation because it was automatically changing as the years changed. What happened from a business perspective? They can read this. They're like, wow, I used to get 100, 80 is still pretty good, but wow, we're getting really low now. What are they doing? They're talking to their congressmen or senators, we need to get this number back up. So as part of the One Big Beautiful Bill Act, it reinstated the 100% depreciation percentage on a permanent basis. This is one of the things, if you follow the financial markets, they're saying there's going to be a lot of stimulus coming. We have the qualified production property we talked about. We have this on a permanent basis, 100% immediate expenses. What you'll see in a moment here is this applies to everyone. There are no phase out limitations. Ford Motor Company is interested in 100%. I'm accelerating a bunch of depreciation. So the range, this is where the government comes in. I think this has been around so long, it's like business is hooked on it. So it's going to be around in some fashion or another. What's going to change is just the percentage. And even though I said this is a permanent basis, if you have the Democrats do well in the midterms and say we have a switch in the presidency the next election, we have a Democratic control, they will no doubt address this. They may be more focused on the deficit, and one way they might do this is take this 100% and dial it back. Maybe they go back to 50%, something like that. Business will be put forth their views, but you know, this is how we make legislation. Okay. So the key for bonus depreciation is there is no total amount of assets placed in service limitation. That example we just went through does not exist in bonus depreciation. It's a separate regime. It's not as old as Section 179 expensing, but it is a standalone law. Again, we don't ever tear things up and start from a fresh sheet of paper. We just build new things onto things that are there. So we have 179 that's sitting there, and somebody comes up with a great idea. Let's do bonus depreciation. We want all the big companies to be able to take it. So the only limitation you have is it's got to be qualified property, typically less than 20 years, and the percentage allowed in that year. Now we're at 100% until such time as they permanently change the law. It will be the primary way for companies to depreciate qualified assets placed in service in 25 for most businesses. So I would love to tell you just to do bonus depreciation and that's it. But the problem is, right, that's from now forward. I have assets that are already in place that I have to know makers that I'm doing things on. And this is only for qualified property, right? So what happens if it's non-qualified property? Back in the basic rules. And you do have a segment of taxpayers out there that are not making money, okay? That can either be a temporary disruption in my business, or let's say I'm a startup and I projected to lose money for a period of time. Acceleration of deductions is not so good for me, right? Because I'm just adding to a loss that's carrying forward, but I may not need that loss now. So I could postpone deductions till the future. So I can, these are elections. So you think, like, well, why would somebody elect me? Why would I have an election that not everybody would take if it lowers my taxable income? Well, what if I don't have taxable income? That segment of companies that are disrupted, not making money this year, or your startup and you haven't yet turned the corner to make money. In that instance, I might want to postpone deductions until the future. What if I think, and I'm confident in this, not me confident, but hypothetical, confident that the tax rates are due to go up. Like, we can't run a deficit in the debt that we have forever. And ultimately, the tax rate has to go up. What if you think the Democrats are going to come in and control, and the tax rate that is 21% today for corporations is destined to go higher because no Democrat voted for the 21%, and they're already on record to think that it should be 27 or something like that. Deduction postponed is not a good idea, but a deduction postponed to a higher tax rate year is a good idea. So maybe how confident I think that the law is going to change, maybe I push a deduction into a higher tax year. That would cause me to not make the selection. But if I'm profitable and I want to drive tax revenue or the lowest tax liability possible, I'm going to elect these regimes. Very popular with business.
What do you mean by apart from the percentage allowed for the year placed in service about like there not being a limit to bonus
Okay,
depreciation?
so historically, so in this chart, historically, now it's 100%. And if I was back a couple years ago, it was, say, 60%. So the only limitation I had was not, it was just the type of property, could be 20 years or less, and the percentage of the year I was, that was the only limitation. Very broad, very open, very popular with business. Okay, let's do 214. So Elaine.
In this example, for R, we are calculating the bonus depreciation for Newton's asset. First, we will look at the total cost basis, which is $4.86 million. The problem tells us that Newton is not using the section 179 expense, so we go directly to calculating the bonus depreciation. The most critical detail here is the base in service data, which is in January 10, 2025. We look at the bonus depreciation table in Exhibit 9, 29. You can see there is the special window at the beginning of the 2025. Because it bought these assets before the date of January 19th. So they qualify for the 14% rate, not the new 100% rate. So the calculation is simply the $4.86 million basis multiplied by 40%. So the final, we can get the number of $1.944 million.
So that was just the date that they selected in the law. And if you did something before that date, then you already made the decision without the new law, knowledge of the new law. And so you get the old 40%. It's unfortunate if you would have waited a week or so, you would have got 100%. Thank you. Okay, next example, 214. Our second part, sorry, Yupeng. Yupeng?
Delivery card did not qualify for bonus depreciation, and then that the difference the maximum section was applied. So there is the difference. And so the 179 qualified the proper it was 4,860 and so which was the minus the 4 million is the limitation of the one section 179 without and without 860 and then we should use the 2,500K to minus the 3,000 maximum expense. So if the answer is 1,640K, and that was the amount and so because the truck is not eligible for bonus depreciation, and we apply and the amount of the truck is 80,000. So we minus the 80,000, and we still got 1,560 for the
So I think, were you doing this part?
Yeah.
Okay, that's fine, we can go through this. I wanted to get to the second one, but we can do this one as well. So what's key here is that my total, I'm partly in 179, right? Because I'm like, say, a medium-sized company, so I'm just over the phase out. So I can claim some 179 immediate expensing. And then for that excess, I can claim bonus depreciation at the end of the day, right? So this is just the sequential nature of this. So you might ask yourself, why would I bother with doing 179 if I could just capture all of this under bonus depreciation, right? Is this just academic, exercise to do? And that's a very subtle question, and it might depend on state tax implications. We don't have a state tax course here, but the way state taxes operate in the United States is they usually, for businesses, they start with federal taxable income, and then they make adjustments. So they have a starting point, and they make adjustments. So since Section 179 has been around for a period of time, many states conform, meaning that they will also allow 179 deduction for state tax purposes. Some states have not adopted the bonus depreciation rule, which means they opt out, which means that you may get more depreciation for state purposes if you do 179 if you're so qualified, than relying solely on bonus depreciation. So this is just where you got to look at this thing in totality. There's subtle differences between 179 and bonus, and you got to look at the totality of your tax plan. Okay. So the second part here. Did somebody have the second part? This part. I'll get my handwriting down right. So all this is saying is compared to this example that we did first, where we just missed the date and we were subject to 40%. Here I hit after the date of January 19th of 25. So instead of going to my makers tables, table 1, or if I were in mid-quarter, looking at more extended periods, I drop straight into 100%. This is the economic proposition the government has put forth to business to get busy on CapEx. Okay. So a few limitations we're going to end up with on depreciation. Listed property and luxury automobiles. So in addition to the basic rules for tax depreciation, they have enacted rules to curb perceived taxpayer abuses. And they're called listed property and luxury automobiles. These have been around for a long period of time. The government hasn't messed with these in a number of years. And so the first one, listed property. Think of this as kind of dual use property. Like an item has appeal for a business, but it also has appeal to someone personally. Kind of a dual use, if you will. So most business-owned assets are used entirely for business purposes. Like a piece of machinery in a factory is only used for that, right? Has no other purpose outside of that. However, some business-owned assets, such as automobiles, laptops, and digital cameras, are also inherently conducive to some personal use. Right? I don't know of a laptop that is used solely for business use. Somebody's always using that for some personal, right? And so it is conducive to some personal use, and we collectively refer to those as listed property. So depreciation of listed property is limited to the portion of the asset actually used for business, right? So we appreciate that some assets have some personal use, but we want to limit the depreciation for the business use of that asset.
Is it like, okay, let's say it's like a company and it's like more of something where, it's like a software that they're creating, like a small business. Would this, like, isn't this listed property, could that not also fall under qualified, like, production property?
Yes, and this serves as a limit to that you would otherwise get.
Okay, so then those other rules wouldn't apply, like you wouldn't be able to deduct all of it in that
They would
year?
apply, but they would only apply to the business use portion.
Oh, so then you split up the value of that property?
Carve off the piece
How do you even
portion.
determine that?
Not easy.
Like with a laptop, like you could use that for everything.
And it's like completely a difficult area for the government to get involved in, because like, am I really gonna spend a lot of time and effort looking at just one this laptop and trying to debate whether it's 20% used personally or 50%?
And
Is
like
that the best use of people?
for like a car, then they'd also have to determine like how many miles, like where you're driving it.
It's really common in company-owned cars
Right.
that are given to somebody. Salesperson is obviously gonna be out visiting customers, but what are they gonna do on a Saturday? They might hop in the company car and use it.
No, I do this for like my personal car, and it's very like basically the tax plan just asks how often you use it, like how many
Yeah,
miles.
same
I'm
concept.
just like I don't really know, so I just
Same
make up something.
That's usually what people do.
Yeah.
That's usually what they do. What do you want me to answer? What do you want the answer to be? So, there's a practicality of how to be compliant with these rules, but the law is the law, right? That's what they're trying to do. Okay, so it's limited to the portion of the asset actually used for business purposes. If the business use percentage is greater than 50, the normal depreciation methods apply, including immediate expensing and bonus depreciation we talked about, but only for with respect to that business use portion. Okay? So just bifurcate the asset between the two uses, and the business use goes through all the mechanics. If the business use percentage subsequently falls below 50%, you don't want to be there because it's a mess. They actually make you go back and adjust and count for other depreciation deductions you take. This is where you run into some instances where the tax code can run amok, where it's like, what are you doing? You're just chasing everything down a rabbit hole. It makes no sense to me. But there are rules, I just wanted you to know. If it was above 50% and during its use it falls below 50%, there's some retroactive stuff you gotta do. That's pretty good. Okay, let's do 216. If I get this right. Anybody sign up for 216?
Assume that in addition to the assets tax purchase in 2025, it also purchased a new digital camera for 4,000 that its employees use for business on weekdays. On weekends, Esteban uses a camera for soccer lives. Because a camera is listed property, the tenant must assess the business use percentage of property calculated stuff for depreciation of the camera. Assuming the tenant determines that business use percentage to be 75%, what is tenant's depreciation deduction on the camera per year, ignoring bonus depreciation? And 179 expenses. Well, given that the initial basic camera for business is 4,000, and we also know that business is over 50%, we still need the regular MACRS depreciation 20%. If we know that it's a 5-year property, on a 5-year conversion of V1, that would just be 20% divided by 5. And that would give us 800 multiplied 4,000 by 22. And given the business use percentage of 75%, we would multiply the depreciated expense times 175.
Yep. So this is ignoring bonus depreciation and 179 expensing. If I had that, I would still run this through that, but it's only going to be 75% is the max I can get because 25% is used. Okay. And just so you know, this assumes that the employer is allowing the individual to use this camera. Right? It's a separate matter if the employer doesn't want the camera to be used for that. But if it is, then I have to haircut it. Okay. Luxury automobiles. So this one's been around and it has a real applicability because think of all the cars that are out there. What I consider luxury, you guys may have a different view of what is luxury, what the government thinks is luxury. But the idea is what I use for business, I can't have that open-ended. Somebody will go out there and buy the most expensive car that's around and use that for business, right? And you don't need that to do the job of whatever the car's doing. If it's visiting customers, or if it's delivering a product, those type of things, you do not need the most expensive car to do that. Doesn't mean that you can't buy that and use that. It just means the government is not subsidizing that by giving you a depreciation reduction on that vehicle. That's all these rules are doing. Right? I'm not partnering with you on buying a Lamborghini to go visit customers. Okay? So the tax tax law limits the depreciation deductions for automobiles by providing a maximum depreciation schedule, which is compared against the total of makers and 179 expense, with the lesser being the amount allowed. So this is a cap. What I can do for automobiles placed in service during the year. In addition to the otherwise allowable maximum depreciation deduction of $12,200, taxpayers are allowed $8,000 of bonus depreciation for a total maximum 2025 deduction of $20,200. Okay, so the way they've structured this limitation is they put a cap on the amount of the deduction you can have. And so what it does is it effectively applies, and these numbers are indexed for inflation, but it affects cars costing greater than $61,000. The reason being is because this $12,200, if you do the math, automobiles in that revenue procedure we covered last week is 5-year property. 20%, so if you take 12,200 divided by 0.2, that gets you 61,000. So this is at the point at which you start getting the limitation. If I buy a car less than 61,000, I just do the normal rules. So this is how they're deciding to limit what's luxury and what's not. $61,000. That number goes up. Okay. And you'll see here, these are the years: 12,200, 19,600, 11,800, before and after. So if you're buying a very expensive car, it's your choice from the business perspective, but it can extend out that recovery period because it's only going to be 7,600 for the years after, so it's really stretch out that recovery. We have an example. So, luxury automobile limitations do not apply to vehicles weighing more than 6,000 pounds. They've always had this weight exception in there. So think of large SUVs. You might have heard a family member or a friend who has a small business and they buy an SUV and they immediately write it off. This is the rule. It weighs more than 6,000 pounds. So they're not in the luxury automobile limitation, so those big SUVs can easily get over 61,000, and the bells and whistles you put on it. And then you're doing bonus depreciation because that applies. Right? So you can immediately write that off. So that's what they're writing that up. I'm writing my. That's because the rules are the rules.
That's strange because I know a lot of electric vehicles are very heavy these days.
Yeah.
And they are they are getting to the
Oh yeah.
largest.
I'm not surprised that the manufacturers don't know this. And like, okay, because the salespeople are out there. What are you buying this for? Oh, you got a landscaping business. You know, you can write this off. Give tax advice. In that instance, you're outside of the limitation, and you're just in the normal rules of which you can get 100% rules. The listed property rules that we were talking about only the business portion equally apply here. So if it's not 100% used for business, then you're going to haircut it first down to the business use percentage, and then see what the. Okay, let's do this example. So 218 is Lauren.
Okay, so the question is, what is the maximum annual depreciation deduction available on the 2026 on the city? Costing $19,950 and the 2024 costing
Vastly different ends of the spectrum, right? If you're the salesperson, they offer you the Civic or the Porsche. This is where the government's deciding, what am I subsidizing and what am I not?
Yeah, so the answer is $3,150 for the annual and $12,200. And this is because if you look at the macro table, the deduction is usually only 20%, but the automobile depreciation limits are
So I didn't do the math, but this is probably 20% on the Civic. Because I'm under the rule, so I'm not limited. But then, if you go back to this table, it's 12,200 is the max I can get for the luxury automobile. Right? And then it extends it out, which is these later years, right? It pulls it out and really like extends out that recovery. So the government is subsidizing it, but way into the future, right? So the subsidy, the present value that's a deduction that's not worth as much. Future deductions are not worth as much as current deduction. Okay. This I think you could really encounter probably in the closely held small business area, where maybe there's an owner or a family member of an owner that has some influence over the business and might be able to say, hey, I really need this portion. Whereas your normal large organization, there's gonna be the natural economic tension between what the business wants to pay for versus what the employee can demand. That's where you're gonna really see these types of things. Okay. Let's do 219 real quick. 219 is, Joe? Yeah.
So suppose Teton purchases an 8,000 card, which is used on specific time for business purposes. Teton would like to claim bonus depreciation. What is Teton's depreciation deduction for the card in 2025? So you can see that this problem takes us through a regular depreciation method, but since we know that this is a luxury automobile above the 61,000 limit, the annual deduction limit for the luxury automobiles is, as all the previous tables showed, 12,200 plus a special depreciation of 8,000, which brings you to 20,200.
Yeah, that's the bonus piece they throw on top of this, but it's limited to 8,000. And so it just goes to show you how all the rules apply. You got the bonus percentage here is 40, but that assumes that it was in that table pre-January 19th for that year. And then you would otherwise, under the normal operation of the rules, be entitled to a bigger number, but you're only maxed out at 20,000. Stretch out that cost recovery. Okay. I want to finish with real quick amortization, and then I'm just going to lightly touch this. But intangible assets, remember, are not depreciated; they are amortized. Okay. Same thinking. Now we do not have tables. So we only do tables for tangible property. So you will not see tables that we go to for intangible assets because they are straight line, effectively. Okay. And there are categories, 4 categories. There are 197 intangibles, organizational and startup expenses. So these are costs that are incurred before a business gets up and running. Your legal cost of getting a corporation up and running, and then maybe your training cost of getting people ready, like the costs you have before you open, kind of startup costs. And then research and experimentation expenditures and patents and copyrights. I will leave you with 197 intangibles. So 197 intangibles, everybody knows what section 179 is in the tax world. I'm sorry, 197. 179 is immediate expenses, 197 is amortization of intangibles. But think about when you purchase a collection of assets. You're buying a division or you're buying the assets of a business, not the stock. You're buying the pieces of the business. You're going to write a check or wire for a lump sum amount of money, right? Now you're going to have to do purchase price allocation. You're going to take the amount you spent and you're going to start assigning that to assets. It's a residual computation. You do this in financial accounting as well. But you start identifying tangible assets, hard assets. Then you do identifiable intangible assets, like specific things that you know are intangible out there. But then you end up with excess value, right? Because you're buying the collection of the assets. It's like the sum of the parts is worth more than the individual parts. So that excess is considered section 197. 197 intangibles. And this has a long history, fascinating tax history of taxpayers and the government going to court about the recovery of the outlay for 197 intangibles. The government lost in the Supreme Court on a case decades ago and decided, okay, we're not going to fight you anymore on this. We are going to give you a one arbitrary recovery period of 15 years. So 197 intangibles are recovered